Can I do
Okay,
that?
so I'll start off. Hello, everybody. My name is TravisTrim. I'm the president and founder of the Finance Association of Laurentian University. I'm also a third-year Bachelor of Science in Actuarial Science and Finance student at Laurentian University. I'd like to say a special thanks to our guest speaker today, Sarah Riopelle, for collaborating with the Finance Association. I'd also like to thank our volunteers of this association for assisting us in creating such a powerful event for students. In particular, I'd like to say thanks to our Vice President, Jason Sokolsky, and our associates, Nil Patel, Michaela Sheehan, Jackson Levitt, Emily Plater, Shrey Aurora, Nur Hassan, and Jacob King. Thank you for all the institutions who have joined today. We obviously have members from Laurentian University. We have people joining from Cambrian College, many local high schools in the area. We thought this was a great opportunity for high schools to come into a university setting and see what types of events they may be able to create or maybe be able to attend as early as next year. We also have members from Rotman School of Management at University of Toronto. We have members from Schulich School of Business at York University, the School of Accounting and Finance at University of Waterloo, Humber College, Ivey Business School at University of Western Ontario, University of Manitoba, Brock University, Wilfrid Laurier University, the University of Ottawa, Fanshawe College, McMaster University, and the Smith School of Business at Queen's University. So we have a lot of institutions in the house today. We also have members from various corporations such as Excellent Capital Management, BDC, and of course, RBC. We also have students joining from these institutions who are at home right now internationally. Students from India, China, the Middle East, Bangladesh, Singapore, and the United Arab Emirates. So thank you very much for joining from all over the world. So we're really happy about the turnout. What are we at here? 163 so far and counting. People are still piling up in the waiting room. So from our whole team, thank you so much. So without further ado, let's begin the event. So as you already know, our guest speaker today is Sarah Riopelle. Since 2009, Sarah has managed the entire suite of RBC Portfolio Solutions, which totals 140 billion in assets. Sarah is a member of various RBC Global Asset Management committees and is also co-chair of the RBC Wealth Management Diversity Leadership Committee. Sarah joined RBC Global Asset Management in 2003 as a senior analyst. From there, she moved to the Canadian equity team as an analyst and then a portfolio manager. Prior to joining the firm, Sarah worked at RBC Capital Markets in both the quantitative research and investment strategy groups. She began her career in the investment industry in 1996 after graduating from the University of Ottawa with a Bachelor of Commerce degree, majoring in finance and international management. She was also awarded the CFA designation in 2001. So I will let you take the floor now, Sarah.
Thank you. Now you're going to test me on my sharing of screen abilities. So. All right, can you see that?
I can see that.
Can everybody, hopefully everybody can see that since you're all on mute. You can't answer me.
Yep.
Thank you. So, I really appreciate you inviting me to speak today, or me inviting myself probably is more the right thing, because I saw Travis's post on LinkedIn and I reached out to him and said, how can I help? And I'm really impressed by the list of participants that he just went through. The fact that the reach here is through so many different universities. I'm so thrilled that there's high school students on here as well, because that's a group that I would really like to speak to more, and also the fact that we have some international reach. So when Travis and I were discussing content, he said, whatever I want to talk about is great, which is a really dangerous thing to say to somebody who likes to talk. So I want to make sure that we leave lots of time for questions. So I will, it looks like a lot of slides, but don't worry, I'm not going to spend a lot of time on each one. I'm going to start today by giving you an overview of RBC Global Asset Management and our investment process, throw a little macro overview in there, because I expect with recent events, you guys are probably somewhat interested in what my take is on the market outlook, and then finish off with some thoughts on a career in asset management before, hopefully if I don't talk too long, we can throw it over to questions. So, what are we and who are we and what do we do? So RBC Global Asset Management is the asset management division of the Royal Bank of Canada. We manage about $500 billion on behalf of both individual and institutional clients. Individual clients, that's you, me, your mother walking into an RBC bank branch and with $10,000 of their savings that they want to put into a retirement savings plan, into a mutual fund. Institutional clients, that's pension plans, endowment funds of large corporations, university endowment funds, and they ask us to help them manage a portion of the assets on their behalf. So when we manage money for people, we manage money for people all over the world, not just in Canada. We have offices in multiple cities, including, see if I can remember them all, Toronto, Vancouver, Montreal, Boston, Chicago, Minneapolis, London, and Hong Kong. The range of solutions that we offer, we offer over 300 different funds in multiple asset classes, and those range from between asset classes, so stocks and bonds, within asset classes. So within fixed income, we manage sovereign bonds, corporate credit, high yield bonds, emerging markets, and also by region. So we have cities in all of those countries around the world because we manage asset classes in all those countries around the world. So Asian equities is managed out of Hong Kong, European equities is managed out of London. And then we also have different styles of funds. So we have both quantitative and fundamental funds. We manage ETFs. We manage style tilted funds, small, mid, large cap types of funds. So lots and lots of different types of strategies. And that's really important for the business that I manage, which I'll talk about a little bit more in a moment. So when I think about the company, I divide it into three different pieces. And I just describe it as three legs of a stool because all three legs of the stool need to be working together at the same time. And so those three legs of the stool, or the three pieces, are product sales and marketing. That's the team that comes up with the new product ideas and figure out how to sell them to our clients. There's operations, and that's the team that makes sure that the company and our products are running smoothly on a day-to-day basis. And then there's investments. That's the team that actually manufactures the products, or we get the money and we figure out where we're going to invest the money. And that's the group that I work for. So talking about how we manage money and what our investment philosophy is. So I've been with Global Asset Management, as Travis said, for the last 18 years. I've actually been with RBC for the last 23 years. So I think I'm in a pretty good position to comment on what our investment philosophy is. So, because I was one of the key drivers behind developing it. I think I can sum it up in a few key themes. So, the first is collaboration. We all work together. We're sharing best practices and ideas. We share the same investment philosophy, even though we all have individual accountability and responsibility for the funds that we manage. We all sort of look at it with the same overarching investment philosophy. We really believe in the power of human and machine. And what I mean by that is pairing strong fundamental portfolio managers and analysts with strong technology and tools. And if you put those two together, you're going to have a really, really strong investment proposition for our clients, relative to somebody who's just sitting there, reading income statements and balance sheets and picking companies. If you pair that type of person together with strong tools that can look at factor and style risks, then it's a much stronger value proposition for clients. And then the last would be a culture of learning and embracing innovation. So, we have a thirst for knowledge and improvement. We're thought leaders in the space. We're constantly asking ourselves how we can do better. We've posted fairly strong performance over the last decade, but that doesn't mean that we're sort of sitting there, sitting back saying, wow, look how good we are. We always are looking at, why is our performance so strong? Is it sustainable? And when we make mistakes, why did those mistakes happen? And how can we make sure that we do better next time? So always learning. So it's getting harder and harder to find areas of the market where we can generate excess returns versus the market. So we call that alpha. So we're, there's the S&P 500 index. We're always trying to make sure that we can beat that index, and anything above the index is called alpha. But that's not the only way that we think that we can add value for clients. There's a lot of different things that we offer for clients versus just strong performance. So, client discovery, what kind of client are they? Are they a conservative client? Are they a growth client? What's their time horizon? What's their risk tolerance? What's their return objective? Why are they investing their money? Are they trying to invest for retirement, or are they trying to make money to save for a vacation? Like, there's all these different types of reasons why you want to invest. And so we can help them put them in the right product for their needs. We're experts at portfolio construction, at risk management, at strategic and tactical asset mix. The key thing is our process is constantly evolving. Right now we've had 10 years of spectacular returns. out of equities. Do we think that the next 10 years we're going to see the same strong returns out of equities? Probably not, which means we need to always be evolving and adapting our process to think about not only what's happened historically, but what we think might happen in the future. So what are our portfolio managers doing to make sure that they can continue to add value in their own portfolios? Well, this is back to that idea of human and machine that I just spoke about. So we want to make sure that we have the right people and we pair them with the right technology and strong tools. So leveraging data is becoming more and more important piece of the investment process. So we're pairing our fundamental portfolio managers and analysts with portfolio engineers and data engineers. And so that's what we see the future of an investment team looking like. It's going to be a combination of fundamental PMs and analysts who are analyzing, continuing to look at balance sheets, income statements, building valuation models, talking to companies. We're going to pair them with what we call portfolio engineers and data engineers to help them leverage those large amounts of data that we think can give them an edge over the competition. And the great thing about RBC is that we have pretty deep pockets that we can actually spend the resources that we need to build those tools for our investment teams relative to some of the other competitors out there. So that's a little bit of an overview of the firm as a whole. I'm going to talk a bit about the business that I manage. So I manage the Portfolio Solutions business. So these are multi-asset strategies, which are a combination of all of the different things that I just talked about, all the different asset classes, all the different strategies, and all of the different value levers. So I manage, it's about $150 billion now, Travis. It's gone up 10 since the last time I sent you that note. That's awesome. Because equity markets have been so strong. And so it's about $150 billion, which is about a third of the assets that we manage in total. And that's the power of what we call the big blue machine. That's the RBC Bank branch network has really embraced these solutions for their clients because it really, as I said, brings together all the value levers that we have in the firm into one sort of one-stop solution. And so basically the clients have comfort that they can hand the money over to us and we can take care of the rest for them. So the key premise behind these solutions is the concept of diversification. You want to own a whole bunch of different asset classes, equity regions, types of strategies. You want to diversify by portfolio manager. And the reason you want to do that is because not all strategies are going to be working well at the same times, or some are going to be doing well, some are not going to be doing well. And so you want to take a diversified approach because you're going to spread out your risks over a number of different asset classes. And it's going to provide a smoother, more consistent return profile. And that's why it's a really good tool for individual clients, because that's what they want. They want smooth and consistent returns over the long term. As opposed to they're willing to give up some of their upside to protect against some of their downside. And so that's, the other thing to think about is it's not just the strategies, it's the asset classes. And so when the economy starts to falter, investors sell their risky assets and gravitate towards safe haven assets like bonds. When the economy is doing well, they gravitate towards riskier assets like equities. And so at any given time, you want to make sure you have exposure to all of the different asset classes. So this slide is a good example of that. It shows, we call this the quilt because it looks a little bit like a patchwork quilt, but it shows the annual performance of each asset class. And you can see that in any given year that the best performing asset class is almost always different. I realize US equities is at the top of the list quite a bit, but it's generally almost always different. The fact that global bonds were one of the worst performing asset classes in 2009 and then became one of the best asset classes in 2020. So that's, one of the reasons why you want to take a diversified approach. You want to own a variety of different investments and you want to blend them together and get that smoother profile. So a global balance fund is the one type of strategy that I manage. That's the blue box that kind of shows up mostly in the middle of the table here. That's right where we want it. We know it's never going to be the best performing, but it's also never going to be the worst. And so that's what we're trying to achieve with this diversified approach. So when you have funds that own a lot of different asset classes, you have to rely heavily on macro forecasting to manage the allocations between those asset classes. So we want to identify asset classes that we expect to outperform or underperform in the near term, and then we take advantage of that by shifting between those underperforming and outperforming asset classes to add value and add to performance. So the key to managing the asset mix like this is to constantly be reviewing our assumptions, our forecasts, and our positions to see if there's been a change in our view that would have us adjust the portfolios. So as you can imagine, we rely on a lot of different tools and people to bring new information to our attention, as there's no possible way that one person like me can stay on top and keep track of everything that's going on in the portfolios. I'm talking to you on an iPad. I have 3 screens directly in front of me, and I have Bloomberg on a television to my left. So I do try to stay on top of everything, but I have probably, I don't know, my direct team is 12 people on the macro team that help us manage all of this stuff. And then beyond that, there's the heads of all of the asset classes around the world that we also rely on to provide information to us when we're managing or looking at the macro outlook. Oh, did I go too far? Nope, okay. So as you can imagine, there's an enormous amount of data to monitor. We have to find ways to package that into what we call bite-sized chunks. And so this is an example of one of our macro dashboards. I'm not expecting you to be able to read it, so please don't all sit there squinting trying to figure out what you're looking at. But it's kind of a visual to reinforce to you the amount of detail that we go into when we're analyzing the economy and the markets. So this is what we call a heat map. Green is good, red is bad. On the left-hand side, you can see the variety of different indicators that we're looking at. And there's under each of those categories, there's a number of other indicators. And then what this is showing is different periods that are similar to this one back through historically. And so we're just trying to see, like, what does the market look like right now? Or what is it, what's our inflation expectations look like? What do valuations look like? And just trying to get a sense of changing trends. So we have a number of different dashboards like this built for different parts of the market. So I'm going to talk a bit about what the outlook looks like, and for all of you who are actually interested or managing assets as part of your student-run investment funds and that, I thought I'd give you a little bit of an overview. 2020 was quite a year in markets, as I'm sure you know. Big difference between the first quarter of the year and then the subsequent 9 months. This slide shows a picture of the various markets leading into and out of the crisis, and we're using February 19th as the start of the crisis, as that's when the equity markets peaked and then subsequently sold off. The sell-off, interestingly, didn't last long, as you know. It was a really painful 4 weeks for me, because not only were we looking at the worst downturn in history, but I was also shifting to work from home at the same time, so dealing with all these technology challenges. The average bear market has lasted 639 days through history. That's almost 2 years, while this bear market lasted 33 days in total. So it is the shortest bear market on history by a long shot. We saw a peak to trough decline in stocks of 34%. That compares to the average bear market return of 36%. So the magnitude or the size of the sell-off was in line with the long-term average, but the duration and how long it took to get there was extremely condensed relative to what we're used to in history. Since then, most markets have staged an impressive rally. It seems like the market is looking across the valley and focusing on prospects for companies in a post-pandemic environment. Given the great run for both stocks and bonds over the last decade, we believe it's unlikely that we're going to be able to replicate that going forward. That's what I talked about, adjusting our approach to a changing environment. So we've been cautioning all of our clients and our investors to expect lower lower returns going forward, because we've expected that the forward returns are likely not going to be what we've experienced over the last decade. In the current market, equity valuations are no longer cheap. They are fully valued in the U.S. equity market, for example. It's the most fully valued market that we look at. But there are still some good prospects in some of the other markets. International markets outside of North America are actually showing fairly good valuation levels, and so our asset mix is tilted towards international and away from North America. So I'm going to go quickly over this because I'm respectful of time and want to leave lots of time for questions. So I can leave this with you guys to look over on your own. The bottom line is, while the economy may experience some hurdles in the near term, the recovery from the pandemic is progressing well, and the promise of the vaccine has helped to clarify the path to a sort of a more normal economy, and it shows a better outlook for 2021. Bond yields are low. We think the bond yields are continue to be low. There's no urgency for central banks to raise rates from here. The one thing they were watching very closely is the impact of a blue wave on inflation. And so a blue wave is the Democrats controlling all three branches of government in the US, and that could have an inflationary impact given some of their policies. And so while our base case is not higher inflation, it is something that we're monitoring closely because rising inflation will have an impact on most of the asset classes that we invest in. So something that we really want to pay attention to. On the equity side, I've got multiple screens going on here in case you're wondering what I'm doing. On the equity side, we talked about the impressive returns off of the March lows. We recognize that further gains in stocks from here are going to depend on above average valuations. But we think there's a good chance of that happening. And that's because in a world of low interest rates, investors are faced with limited investment alternatives. And so stocks, we think, are going to continue to attract capital and going to continue to keep valuations above their long-term average. And so we're overweight equities in our asset mix to recognize that, because we think over the next 12 months, stocks will beat bonds, and we want to take advantage of that. So we are overweight stocks and underweight bonds in our asset mix. All right, on the fly, keep going here. Okay, so the last thing I wanted to do, I realize I talk fast, but it's just trying to get through a lot of information and give you guys as much as I possibly can in a short period of time. And so I'm sure we'll get to cover some of this in more depth in the Q&A session. So forgive me for going through this so quickly. Career and asset management, I thought would be something that would be really important for you guys. So I wanted to make sure I had some time for a couple of slides on that. So this is a picture of my own career path. Not very exciting, as I've been with RBC for the last 23 years. I did not know when I joined RBC 23 years ago that I would become what they call a lifer, but it's a great organization, so I can't complain. You can see here I've had a variety of different roles. My career path has certainly not been a straight line. I've come a long way from being an admin assistant to a corporate finance team when I graduated. I've had roles in investment banking, quant research, macro research. I managed Canadian equities, and now my current role, which was actually created specifically for me, which is a dual role of managing all of our multi-asset strategies. But I also work very closely with our chief investment officer to manage our global investment team. So when I'm speaking to young people, I caution them to not be too focused on a single role. You may think you know what you want to do when you graduate, and I think that's great, but you also have to be open to other opportunities as they present themselves, because it's highly unlikely that your career is going to be a straight line from graduation to Canadian equity portfolio manager. It's a journey, so you're going to have a lot of different things that you're going to do in between. And my view is that as long as you're learning new skills that will help you get to your ultimate goal, then you're not wasting your time in any given role. So I'm often asked what a typical day looks like for me. I'd actually like to, I'm afraid to say there's no typical day for me. Every day it's something different. And I think that's why I find it so interesting, is because people describe me as someone who thrives on chaos. And so the fact that every day something else comes up that I need to deal with just keeps me on my toes and keeps me interested and keeps me coming to work every day, so to speak. Today I'm spending time with you guys. This is my 4th presentation of the week. I've made a couple of client presentations. I taped a podcast, and then now I'm speaking to you guys. This weekend we'll focus on writing a LinkedIn post on what a balanced fund of the future looks like. I have an asset mix meeting on Monday. So every day there's something different. I have a to-do list that's literally 5 pages long. So there's never a shortage of things to do. But like I said, that's why I love it. The variety is great. I never get bored. It's the chaos that I love. So another topic that I often am asked about is, how do I balance my work-life balance? So how do I balance work and family? Well, the truthful answer is I don't. I don't think there's any such thing as work-life balance. And so I don't want you guys to, have unrealistic expectations on that front. What I will say, though, it's about making choices. So every day is a different choice. Some days work wins out, some days family wins out. You have to make sure that everybody's is getting their time. My family understands that if I'm working on a presentation or I used to travel a lot before we all got locked down. But if I was traveling, then it might be that I would miss one of their events. And they totally understand that because they know I work hard for the family. But then some days when I am home, I'm not traveling and I am home and my daughter has a dance recital, then I will take the afternoon off to make sure that I can get to her dance recital. So it's all about balancing the two. I have to admit that the work from home environment has helped somewhat. I'm no longer traveling. I don't have the commute to Toronto to the office. I live in Hamilton, by the way. So I commute to Toronto every day. I went to go to the office. And so the fact that I'm in a work from home environment actually means I have more time with family because I can eliminate some of that travel time. But I do miss the interaction with the investment team. I traveled a lot to visit all of the investment teams around the world in all those cities that I mentioned earlier. So I do look forward to getting back to normal sometime soon. And one thing that I often talk to students about is they all want to be investment bankers when they graduate. They think that the only role for a finance grad is to become an investment banker. I'm here to tell you that is absolutely not the case. I mean, investment banking is a job that you can get if you graduate with a finance degree, but there's so many other jobs that you can have. And what I attempted to do here is to list all of the jobs that we have around RBC Global Asset Management. So there's lots and lots of different options and opportunities available. This slide, earlier I talked about there's 3 legs of the stool. I've actually added a 4th on this one. I know that's cheesy. Should get a new metaphor, but I think data and technology is going to become its own leg or pillar, as you say. I talked earlier about technology and data becoming such an important part of the investment process. I just think that the future is going to really embrace things like machine learning, big data, data science, artificial intelligence. All those types of things are going to become important parts of the investment process in the future. And so I think it warrants its own separate box on here. Don't worry, I'm almost done. So I thought a good way to finish up is to provide a few tidbits of advice. I meet a lot of people looking for career advice. I do a lot of coffee dates. In fact, I get so many requests now. I try to limit them to 1 or 2 a week, and I'm already booking into March. So for all of you people out there, if you do reach out, I'm just warning you, it might be a while before we were able to connect in person. So a few tidbits of advice here would be: 1, have realistic expectations. You can't go directly from undergraduate degree to portfolio manager. You're going to have to start at the bottom and work your way up. So make sure you understand that coming out. Make sure you consider all your options and opportunities as they present themselves. Don't pigeonhole yourself into a single path, because as I mentioned earlier, your career is not going to be a straight line. Have a mentor or supporter is going to be really important. You need somebody that you can bounce ideas off and talk things through with. So whether it's personal or business related, having those types of sponsors and mentors is really important. And then the final one would be: give some careful thought to your personal brands. Only you can decide how people are going to see you. And so I would say you want to dress for the job that you want, not the job that you have. I know that sounds really cheesy, but I've said that word a couple times today already. Me personally, I get up every morning and I shower and put makeup on and do my hair and put proper clothes on from the waist up, haha. And make sure that, because I know I'm going to spend my whole day on video calls. And so I want to make sure that I'm, just like I would go to the office wearing a suit every day, I want to make sure that I am well put together when I put myself on a video call in the morning. Many of my colleagues are not doing the same thing. I can't believe the number of colleagues that I have who haven't shaved or cut their hair in 9 months, but that's their choice. So all I'm saying to you is, you think about what your personal brand is going to be and make sure that you're putting the best you forward that you can to get the job that you're looking for and to be successful. All right, I only went 4 minutes over. That wasn't too bad, Travis.
Well, thank you so much for that presentation. I'm sure that everybody learned quite a bit. So I just got a notification that our dean has joined. So I'd like to say thank you so much for coming in, Dr. Michelle Delorme.
Thank you.
Well, it is my pleasure to join you. I would like to thank the organizing committee for this initiative. I would like to thank the speaker for sharing her experience and good knowledge and tips for our students. This is what we have to do within a business school. So thank you so much, all of you, and I wish you the best. Have a great day. Thank you.
Thank you so much.
Thanks very much. They've done an excellent job, Dean, of putting this whole thing together and getting the message out across many different organizations. So kudos to them.
Yes, I'm really impressed by the quality of our students, really. Thank you for sharing.
Thank you. Okay, do you want to stop sharing your screen, Sarah, and then I'll get into the
sorry.
Q&A.
Yeah, I was supposed to do that, wasn't I? Okay, sorry.
All right, so we will jump right into the Q&A session. When I call your name, please state your name, state what you study, and which organization you're from, okay? Okay, so our first question comes from Liam Passy. You may turn your camera on and ask your question.
Hi, Sarah. Hopefully everyone can hear me.
Yep.
Yeah.
Yeah, okay, awesome. So yeah, I'm a recent graduate of Laurentian University, double majoring in actuarial sciences and economics. And I'm currently working at RBC in Sudbury as a banking advisor.
Oh, my favorite people.
Yeah, exactly. I'll be sending you lots of clients. I just got to pass that IFIC exam and we'll be there.
There you go.
Okay, yeah, so just for some context, in an interview last year that you did with RBC Wealth Management, you stated that lower real interest rates are probably going to stay for some time, and that you continue to expect the world to remain in a low to moderate inflation regime, which you kind of touched on today. So just my question with pertaining to Canada is, since it's posted its largest deficit ever, being about 20% of the GDP, which is fourth largest in the world, according to an IMF report cited by Bloomberg, and obviously printing a large amount of money and experiencing a high unemployment rate, do you think inflation will remain low? And if so, why? And it's also kind of a two-parter. Onto that, I would add, also, do you think Canada is in its current state will be used as a case study for modern monetary theory? And what do you think about modern monetary theory in general?
All right. Liam,
thanks a lot. A lot to unpack. Sorry.
Could we not have asked a question like, how many children do you have and what do you like to do in your spare time? No. All right. So I am not the expert on the Canadian economy. Like I said, we have our chief economist. I have a whole economics team, and so you're catching me on a topic that I cannot give you in-depth answers to. We are not particularly positive on Canada in our asset mix. There's competitiveness issues in Canada. There's housing bubble potential issues in Canada. We are a market that is focused on two main sectors, which is basically banks and energy companies. And so we're driven by interest rates and we're driven by commodity prices. And so all those make Canada a little bit more challenging economy and market to work in. So I want to be really clear here. I don't want everybody to say she hates Canada. She just said we're going, anyway. So I'm saying on a relative basis, if I'm looking at Canada relative to some of the other markets that I have available to me to invest in, Canada is not on the top of my list. Okay. We're looking for sort of mid-single digit returns from the Canadian equity market over the next 12 months. Canadian inflation, for all the reasons that you said, we do not expect inflation in Canada to rise by any substantial amount in the near term. But that said, there is always some connection to the US. So what happens in the US gets reflected in Canada to some extent. So we do have to be aware of that. Modern monetary theory, that is a question I am not going to tackle on this call because it could take me a long time to get through that answer. So we can take that one offline, Liam, if you like, and I can you can send me an email and I can send you some stuff on that.
Awesome. Thank you.
Thanks.
Thank you, Liam. Our next question comes from Sean Ruman. You may turn your camera on and ask your question now.
Hi, Sarah. Thank you so much for taking the time to speak to us today. My name is Sean Ruman. I'm a candidate for Master of Science in Management and International Business at Ivy. My question to you today is, what factors do you consider most often when planning a strategic investment?
Oh, that is a very complicated question. It's a really long list, so I'm going to give you some high level details. So what we're looking, when we're optimizing portfolios, we're looking at mainly risk and return. So we're looking at expected return, historical returns, expected returns, standard deviations, Sharpe ratios. Those are sort of the main metrics that we look at. But there's a whole lot of other things that we look at as well, which is drawdowns, how they perform during different market cycles. So if we put a portfolio together and we want to say, like, how would it have done if this had existed in the crash during the financial crisis, or if it's, how would it exist during the taper tantrum of a couple of years ago, right? So we do look at different, so we do a lot of scenario analysis. We also look at, we don't rely on historical returns because, as I said, the last decade of returns in terms of bond returns in particular is not going to be the next decade of returns for bonds. So we want to look at both historical returns as well as expected returns, so that we're building a portfolio that can actually endure over time going forward, right? So I'd have to, like, the analysis that we look at is, it's upside, downside capture, maximum drawdown, Sharpe ratio, expected return over multiple different time periods, standard deviation. I don't know, those are the only ones that are coming to my mind, but there's probably 15, 20 other metrics that we look at the same time. The key for us when we're optimizing portfolios is correlation. So we were looking for uncorrelated assets to add to the asset mix because that helps with the diversification. And so, we're right now, because sovereign bond yields we think are going to be low for a long time, we're going to have pretty mediocre returns out of sovereign bonds. We're looking for uncorrelated asset classes that will provide some of the similar components to the portfolio that sovereign bonds used to do. So we're looking for income, we're looking for yield. So something we're looking at absolute return bond funds we just added. We're added a real estate allocation. We're looking at mortgages and infrastructure. So different ways to mimic the previous factors that sovereign bonds were adding to a portfolio. I don't know, that's a very long-winded answer to your question.
No, I get it. Thank you very much, Sarah.
Thanks.
Okay, so our next question comes from Calvin Henderson. You may turn your mic on, or turn your camera on, and ask your question.
Hey, Travis. Hey, Sarah. Is my audio coming through okay?
Yeah.
Yeah.
Great. So I really enjoyed your presentation so far. I want to take a quick second to congratulate Travis on putting together such a successful event. You've done great. My question for Sarah pertains to passive investing. The consensus right now seems to be that going forward, there's going to be an increased level of capital allocated to passive index strategies, factor strategies like smart beta through ETFs. And from my standpoint, that will likely create a large level of market inefficiencies. I think there's something paradoxical if all fund managers treat the market as if it was efficient and invest in that way. There's going to be a neglect of non-index constituent securities, and the value of index constituents will likely be inflated above anything that approximates intrinsic value. So I wanted your thoughts on that.
Yeah, no, I agree that I think the greater volatility that we're seeing in markets over the last 12 months, let's say, is probably a big function of the amount of money that's following ETFs now, because as prices move and as markets move, those ETFs have to play catch up. And so they're basically just piling on in the same direction of the trade that's already going because they're trying to match the index. So I think more ETF and passive investing is going to lead to more volatility in going forward. We do use ETFs within our portfolios for some segments of the market. For example, large cap US equities is the hardest market in the world to manage money in. It's the hardest market in the world to generate alpha in. And so in some cases, it might make sense to use a passive ETF for your large cap US equity exposure, and then layer that on with some active management in other areas of the US equity market, because we think you can still generate alpha in small and large cap US equities, in growth and value equities versus just plain vanilla large cap. And so we do use ETFs as a tool as part of our asset allocation. As you know, you may not know, but we have a partnership with BlackRock in Canada. And so we're actually the largest ETF provider in Canada and growing. And so we certainly see a place for it, but I think it's about it's not about whether our funds better than ETFs. It's about how and when you use an ETF as part of a multi-asset solution. So there's a time and there's a place. And so you just have to make sure that you're making smart decisions around when to use it. I don't think it's a matter of, I should sell all my mutual funds and put all my money into passive. So I think it should be a mixture. We actually do some, because we get this question a lot, we actually have some work done that compares our net of fees performance of all of the mutual funds relative to the equivalent ETF. And 80% of our mutual funds on a net of fees basis are beating the equivalent ETF. And so we still think that there's money to be made in active management. So we don't recommend a purely passive approach, but as I said, ETFs are a tool that we use when we're managing the asset mix.
That's a great answer. Thanks.
Thank you.
Our next question is from Zain Kumar.
Hey, thanks for the opportunity, Travis.
You're in your car.
Yes.
He's at
for
work.
those of
He
you
had to go to
wondering,
his car.
yeah, I'm at work and it's quite noisy, so I just decided to sit in my car.
Thank you.
Well, a question for you, Sarah, is a rather simpler one. I'm a student at Cambridge College studying business accounting, and you know, I wanted some guidance on moving forward. You know, which certification, you know, according to you, comparing between MBA, a CFA, or a CPA would serve the most value in order to move up in the financial ladder?
So that's tough for me to answer the CPA side of things, because I certainly am not going to discount you getting a CPA since you're in an accounting program. So I'm going to focus on the MBA versus the CFA because that's a question that I get quite a bit.
Okay.
If you have any interest in managing money, like becoming a portfolio manager and actually managing assets, a CFA is a mandatory designation to have. And I don't say that lightly. I'm not saying I personally think it's mandatory. We're all registered with the Ontario Securities Commission to be able to manage assets on behalf of clients. And the Ontario Security Commission requires a CFA as a mandatory designation to have in order to be registered. So I'll tell you a funny story is that a year ago, we hired a new head of mortgages, and he has 30 years of experience in the mortgage business and managing mortgage assets. He does not have a CFA. A year later, I am still negotiating with the Ontario Securities Commission to try to get him registered as a portfolio manager so he could actually touch client assets. And their main thing is, I know he has 30 years of experience. He doesn't have a CFA, so we're not registering him. And so, you know, if asset management is something that you're very interested in, then I would recommend a CFA. It's also a useful tool in investment banking and like any of the finance, you know, industry type disciplines. The CFA is kind of what we call table stakes. It's a must-have. So it kind of depends on what you're thinking about your career path. MBAs are excellent as well. I'm not going to try to offend any of the professors or students on here who have MBAs. I think that's great. I think MBA is probably more focused on strategy, relationship building, big picture thinking. I think CFA is a little bit more focused on, you know, the details of, you know, managing assets and understanding asset classes and more finance. And so, and then obviously the CPA, you know what that is. So it kind of depends on what you want to do with your career. So the first thing you have to say is, like, am I interested in, you know, being the CEO of a company? Am I interested in working for E&Y as an accountant or a consultant, or am I interested in managing assets on behalf of clients? Because once you have a bit of an idea of what your path should be, will help you make a better decision.
Amazing. Thank you for that answer.
Next question comes from Michaela Sheehan.
Hi, so I just want to say thank you again for being here, Sarah. My name is Michaela Sheehan. I'm a fourth-year finance student at Laurentian, also an associate for the Finance Association. So yeah, my question is going to be a little bit more general. So as a woman aspiring to pursue a career in finance, do you have any advice on how I could kind of differentiate myself from other candidates when applying in the field? I know you kind of brushed up on it a little bit already, but.
Yeah, so there's so many finance graduates out there that seem to be going all for the same types of jobs. And so you do really need to find a way to differentiate yourself. Some of the things that I think, I'm mentoring a student at the University of Ottawa, and I just read his resume, and I thought he did a really good job but one thing I noticed on it is I've read that resume 10 other times, right? Like they all kind of look the same. So we look for things like demonstrating leadership. So the fact that you're part of this organization, I think is a great example. People who have work experience. So make sure that you're getting co-op or summer interns roles while you're in school, because people who come out of school never sort of having worked a job in the industry makes it a little bit more challenging. One thing I talked about is Bloomberg is really important. So if you can come into a role and say, I already know how to use a Bloomberg, that really helps a lot. So I know University of Ottawa, I spend a lot of time with them. I know that they have Bloombergs in their finance lab. I don't know if you guys do as well, but if you don't, you can, go online and there's courses to teach you how to use it. So those types of data and tools. So coming as a junior analyst coming in, you're going to be the one that's going to be responsible for manipulating all of that data and stuff. So you need to make sure that you have the skills to be able to do that. So whether it's Excel macros, being able to do Visual Basic macros, whether it's taking a course and learning Python, we're actually requiring all of our analysts on the team to learn Python. So they've already have the job, so we're getting to learn Python, but I expect all of our new analysts coming in, we're going to be looking for people who actually already have Python skills. So that's something to think about as well. And then any opportunities that you get for public speaking, I find that you need to be able to communicate, you need to be articulate, you need to be comfortable speaking up in front of people. So when you come in for the interview, you need to make sure that you're asking questions, you're engaged, and you're excited. Because we have people that come in and if they're very shy and don't really ask questions, it's hard for us to figure out whether or not they would be a good fit or not. So we're looking for people that sort of are dynamic and engaging. And it's not a fact that a lot of the times in the interview, it's not that they're not dynamic and engaging, it's that they're nervous and uncomfortable. But we can't get past that because we only have that 1 hour opportunity to meet them. So I tell them any opportunity you get to get outside your comfort zone and make presentations or go and to events, meet and greets or cocktail events or something, and get used to making conversation with other people. Get outside your comfort zone if that's something, because I can speak from experience that is not something that I'm comfortable with. I hate cocktail parties, but I have to do it a lot. And so I force myself to do it, and practice makes perfect. The more and more you do it, the more comfortable you get. And yeah, that's all I can think of off the top of my head.
Okay, thank you.
Thanks.
So the next question was requested that the moderator ask. This question comes from Julian Blanchard of Laurentian University. What are some of the greatest challenges you have faced in your position?
How long do you have?
5 minutes.
Right, I won't do it in 5. I will do it in 1, so you can ask another question.
Okay.
For me, we talk about this number, the $140 billion number. That's $140 billion of Canadian clients' retirement savings, essentially. And so when we get into environments like February and March, when the market is selling off, my clients pay me to not be emotional, right? Because they're emotional about their investment decisions. They panic and sell at the wrong time. We all know the old adage about retail clients is they sell at the lows and buy at the highs, right? And so they pay me not to do that. And so, but in an environment like February 19th to March 23rd, where markets are just in free fall, it's hard. The hardest thing for me is to take the emotion out of it and because I worry about these retirement savings of these clients. So I need to take the emotion out of it. I need to make prudent decisions. And so we were in the market near the end of March. We were actually buying stocks as they were selling off. It was painful. You can only imagine as stocks are in free fall and you're in there every day buying a little bit more and buying a little bit more and buying a little bit more and saying, wait, is this the right time? Anyway, it all ended up working out well in the end because we got our equity weight back up to where we wanted it, right around the March lows. And then what the next 9 months brought. So it was a good thing that we did it. But I can't say that it's easy. It's, been doing it a long time, but it's still painful every time I do it.
For sure. Our next question comes from Jake Janicki.
Travis. Hi, Sarah. So I'm a candidate in the Management of Science and International Business and Management program at Ivy Business School. Thank you so much for speaking with us. So my question, Geeta Gopinath, Director of Research at the IMF, says that for the first time in a decade, they're seeing a reversal in global integration and trade. Do you think this is indicating a long-term trend for the future? And if so, would your team perceive this as a threat or an opportunity for your portfolios?
Wow, globalization, a reversing in the trend of globalization. I don't know, I have to give that one some thought. So globalization has been a key trend that has helped markets over the last decade, because markets are now much more interconnected than they ever have been in the past, and that was really helped with the flow of goods across borders. That's helped, and we started to see a reversal of that with the U.S. under the current president. Because he started to hunker down and he started to close borders and he started to pick fights with China and say, we're not taking your stuff anymore. I actually think, just quickly trying to think it through in my head, I actually think a reversal in the trend of globalization would be a negative for the world of global economy and markets. I think if people start to hunker down and really just think about their own borders, and about putting tariffs on stuff coming in and out, I feel like that's going to increase the cost of goods and that's going to push prices higher. So it could be inflationary. But that's just off the top of my head. I'd have to give it a little bit more thought. Sorry, Jake.
Thank you.
Okay, our next question comes from Jason Sokalski.
Hi, Sarah. Thank you again for coming on. I'm Jason Sokalski, the Vice President of the Finance Association. My question for you is, what do you think are the most important qualities and attributes of an individual who manages money? Additionally, what do you look for in a good coworker?
So it is interesting. I do a lot of work on diversity, as Travis said earlier, and people ask me, what's the difference between a man and a woman managing assets? And men are much more short-term focused, and they're much more just like, the trade they want to make today. They are a little bit more concerned about valuation than fundamentals, whereas I find women have a much more long-term focus. We're worried about the fundamentals and less about the valuation. And but those are both good things. And so what we try to make sure we do is that we build diverse teams, because that you put those two together and you're going to get much more robust decision making than you would with each individual on their own, right? And that is true of not just gender, but of all different varieties of diversity. So whether it's educational background, cultural background, gender, any of those things, is you want to make sure that you're building diverse teams, because I think that's going to lead to better decision making ultimately. What I said about earlier is that you have to be really good at taking the emotion out of your decision making. So I've gotten very good at, I can get mad for sure, but I get mad to myself, or I get mad to my boss. He and I have been together for a long time, but I don't openly show that anger with people outside of my office. So because you have to sort of take a step back and say, okay, so I understand that we have this trading error. How did we get there? What are we going to do to fix it? As opposed to, you did what? So, right. And so I think you have to show leadership, calmness in the face of adversity. And I'm not going to say nurturing, but I treat my team as we're all just one team and we're all in it together and we're all working together. I still have the ability to step in and say, today, now I'm the boss. I'm not your friend. I'm your boss now, right? Like you have to be able to balance those two things. In terms of what I would like in a colleague is I want somebody who's excited to come to work every day, loves what they do, is passionate, is thinking all the time, is reading, trying to do better, just people that I just want to surround myself with, I guess, people like me who they don't come to work every day just because they have to, but they really love being here and they love what they do and they have a passion for it. And those are the types of people that you want to be around, because that's what makes the job interesting.
Thank you, Sarah.
Sarah, would you have time for one last question?
Okay, it's got to be quick because I'm supposed to be on a 1 o'clock meeting.
Okay, sorry. You know what? Well, I think we'll wrap it up there.
No, you're
okay?
fine. No, ask one more.
Okay.
No,
all right.
Okay.
All right. Sorry, I feel bad because this person specifically has helped us quite a bit. Our last
Okay.
question is from Evan Stock.
Right. All right. Well, I mean, I'm honestly just so grateful for this. What do you think predicts success in roles in finance most of all?
The first word that jumps to my mind is discipline. All of my team members, I really expect them to I don't know. I'm going to say a bunch of stuff. So I expect all my team members, I expect them to listen and learn, and to do what they're told to some extent, but to also challenge me when they think that I'm wrong. I don't want them to say, oh, she's the boss, I better just do what she says. I want them to feel comfortable that they can say, actually, I don't sure that's the right way to do things. But the discipline piece is really important for us when we're managing assets, is because we have an investment process and an investment philosophy that we cannot abandon in the face of adversity. So that whole idea of buying stocks, as stocks were selling off in March, we stuck to our discipline and our investment philosophy and process. And even though it was painful to do so at the time, it was the right thing to do. And so that's why that first thing that comes to mind is discipline.
Awesome. Thank you.
All right. Thank you so much, Sarah, for this wonderful meeting. I think everybody learned so much from you. So from everybody, just again, thank you. I know you have to go, so I won't hold you up anymore. Yeah, so no, if you need to leave, that's totally okay. For everybody that's still here,
thank you, Sarah.
I want to promote the next event we're doing. We have an event on Thursday, February 11th from noon to 1 p.m. It's Rajan Bansi, head of RBC Investees. Okay, you guys are the first to get this link. Nobody else has this link, and we are expecting to go to full capacity at this event. So please click this link, register now to guarantee your spot at this event. And yeah, like Jason said, go and follow our LinkedIn page. That's where we post everything. But please, guys, go click this registration link, get registered for this event, because like I said, we're projecting to go straight to capacity. And if you don't get there on time, like we're gonna have to close the registration box. So if you get in now, you're going to have a seat at the meeting. So anyways, yes, from my whole team, thank you so much for everybody to be here today.
So awesome.
All right. I won't hold you guys up anymore. See you later.
Thank you, everybody.
Thanks, Travis.
Again. Bye-bye.
Bye, guys.
Thanks, guys. Have a good one.
Thank you.
Have a great day, guys. Thanks for setting it up.
Thank you, Dean. Thank you so much.
My pleasure. Thank you for everything. Well done. Congratulations.
Absolutely. We're so excited to continue this event series.
Yeah, exactly.
And we'll be there at your event next Friday with Susie York.
Excellent. Thank you. Very good.
All right. Bye, everybody.
Bye.